everyone, I'm Marina J.A. So I will discuss about rationale, objectives, and principles of regulation. So there are four elements to regulation. So the first one is institute of rules of conduct or rules of operation. Second one is monitoring, observance or whether the rules instituted are obeyed. The third one is supervision, observance of the behavior of participants. The last one or the fourth one is enforcement, ensuring that the rules are adhered to. Regulation has profound effect on the operation of the financial markets and its development, and it has to be adjusted frequently as developments in the financial sector take place, or it must be efficient. However, to remain in this step with innovation in the financial system is no mean task, because the business of financial sector is innovation, and this applies particularly in banking, which is at the very center of the financial markets. There are other issues pertaining to regulation are covered in this section under the following headings. So, which is rationale for regulation, objectives of regulation, principles of regulation. Rationale for regulation is the financial sector plays a pivotal role in the economy, in that in its absence or partial failure, the economy machine will be severely damaged. Imagine if the payment system failed, or the banks are closed for extended periods. So such as, for example, such as occurred in Argentina in 2001, where segments of the economy were reduced to barter trade. So these sectors also carries the responsibility of allocating capital to the most productive uses. The main rationale for government intervention is market malfunction, which means that the financial system will produce a suboptimal outcome in the absence of regulations. The rationale for regulation amounts to why regulation is necessary. There are a number of reasons. The first one is systematic malfunction. Second one is market imperfections. Third one is moral hazard problem. The fourth one is economies of scale. The fifth one is consumer confidence and consumer demand for regulation. Last one is supplier demand for regulation. Systematic malfunction is the financial system plays a vital role in the economy, and failure or malfunction of the system can disrupt economic activity severely. Banks are the only financial intermediaries that intermediate between all sectors of the economy, like household, corporate, government, and foreign, and all the other financial intermediaries. In addition, the bank system provides the payments and clearing system for all transactions that take place in the economy. The failure of a major bank not only causes losses for depositors and shareholders, but also disrupts payments and the settlement of previously affected transactions immediately and possibly for some time. Market imperfections. If the market were perfect in terms of competition, there would be no cause for intervention by the authorities. Perfect competition does not exist, and the consequence is that there are market imperfections. There are many examples of market imperfection that stand in the way of consumer protection. So the first one is problems of asymmetric information. That means is some person have information that is denied to other person, or some person supply information that is ambiguous or incorrect to other persons. The second one is inadequate information on the part of the consumer of financial products and services. The third one is consumer are not equally equipped to gauge the quality of bank products. And then consumer not able to assess the safety and soundness of financial intermediaries and agents in the financial system. Principal agent problems. The director and manager act as agents for the investors and shareholders of a financial intermediary, for example, the principals. However, the agent may pursue their own interests at the expense of the principals. The best example is that the managers and directors may have performance bonus scheme that encourages them to take risks in the financial markets. The moral hazard problem. The moral hazard problem in banking is associated with government preference for the introduction of safety net arrangement such as lender of last resort facilities and deposit insurance. The most potential hazardous is the latter. Deposit insurance creates a condition that the events insured against or losing the deposit it is more likely to occur. And then economies of scale. Uses of financial products or for example deposits ideally should monitor the behavior and sounded financial intermediaries and markets. Consumer confidence and consumer demand for regulation. The role of regulation is also to set minimum standards for products in order the consumer gain confidence in the system. Then, consumer demands for regulation is rational for the following reasons. So, these are the reasons, like lower transaction costs, consumer have a lack of information, and even if they had information, they lack the ability to use the information. Consumer require a degree of assurance in their transaction with financial intermediaries. They may had a bad experience with the bank in the past. Well, that's right. The value of a long-term contract, for example, is 3-year deposit may be affected by the behavior of financial intermediary during the period of the deposit. And then, next one is supplier demand for regulation. It is in the interest of supplier of financial products to demand regulation. The motivation is that ill-behaved intermediaries may affect the business of well-behaved intermediaries. Well, correct. So it's not good to make a bad way. So because you can affect the other people who are doing a good way. So it's a big no. Don't do that. And then in some countries, the ratio of notes in circulation to total money stock is significantly higher than in other countries, despite the existence of well-managed intermediaries. And then the next one is objective of regulation. So the ultimate objectives of regulation need to be narrowly defined. The first one is promotion of financial stability. Second one is promotion of fair and healthy competition. The third one is promotion of consumer protection. Promotion of financial stability. Financial stability is usually seen as having two elements. For example, price stability and stable condition in the financial system. A central bank defines these two elements as follows. So, price stability is achieved when changes in the general price level do not materially affect the economic decision-making process. And then, the stable condition in the financial sector sector are achieved when there is a high degree of confidence that the financial institution and financial markets are able to meet contractual obligation without interruption or recourse to outside assistance. Such stable conditions do not preclude the failure of individual financial institution. A financial institution can fail and be allowed to fail even under stable financial condition. It is only when the whole or an important part of the financial sector is at risk that the situation can be described as financially unstable. These two elements of financial stability are interrelated. It will be evident the financial regulation pertains to the second element. For example, stability of the financial sector or promotion of financial stability, as the heading of this section states. These objectives may be split into two categories, which is systematic stability, and then the second one is institutional safety and soundness. So what is systematic stability? Systematic stability means that the financial system is not compromised in any way. For example, the financial system is not subjected to shock caused by the participants themselves through reckless trading, poor market infrastructure, and inefficient clearing the settlement system, lack of market liquidity, inefficient payment system, and ineffective security delivery system, or the latter is also called delivery versus payment. So kung sa Shopee pa, COD. Institutional safety and soundness is closely related to the aforementioned and means that the authorities have to ensure that the intermediaries that make up the financial system are profitable, have sufficient capital to cover risk exposures, are competitive internationally, and are driven by fit and proper management of directors. Promotion of institutional safety and soundness also means that the regulator should not impose regulatory hurdles that would impair their safety, or promotion of fair and healthy competition. A major objective of the regulator is the promotion of fair and healthy competition in the financial system. This ensures competitiveness internationally and fair pricing for the consumer of financial products. Healthy competition and fair pricing also aids in the efficient allocation of financial capital. Another important dimension here is the effectiveness of monetary policy. Monetary policy can only be effective in an environment of intense competition amongst financial intermediaries, and this applies particularly to the banks. Promotion of consumer protection. A crucial objective of the regulator is to protect the consumer against the failure of intermediaries and against fraud. Is the principle of regulation. The principle of regulation are the principle that needs to be applied when formulating regulatory policy. Specific regulatory requirements and the structure of the regulatory institute there are derived from the objectives and may be categorized as follows: efficiency-related principles, stability-related principles, conflict conciliatory principles, or to address conflicts between objectives, regulatory structure principles, and the last one is the general principles. Effective related principles is that reside under the heading advance the achievements of a higher level of efficiency in financial services, and there are two of it. Promotion of a high level of competition amongst financial system participants. For example, is that the removal of restrictive practices that impair trading in financial assets, low barriers of entry to the financial markets, freedom of choice regarding financial services. And the second one is creating competitive neutrality between existing and potential supplies of financial services or level playing field. Stability related principle is that contribute to the promotion of stability in the financial system and the safety of financial intermediaries and institutes. There are incentives for prudence assessments and management of risk. This means that this requires the impositions of minimum prudential or the kabutihan standards to the observed by participants, of which the capital requirements is the most important. Appropriate information systems are required. Cross-market risk management is also essential. The second one is use of regulatory requirements that are based on market values. Yes, this is approved. The availability of an institute can only be gauged with the use of markets values of balance sheets items as opposed to historic values. Willingness of regulators to take timely action to redress existing and future developments that threaten the stability of financial institutions and markets. This means that the regulator should take appropriate action whether actual or potential market deficiency are detected. Conflict conciliatory principle is that are designed to address potential conflicts between regulatory principles. Regulatory structure principle is an unsolved debate in regulation circles is whether there should be a single regulator or a number of specialist regulators. General principles are those that have bearing on the general conduct of regulatory process, and they are the first one is each regulator arrangement must be related to one or more of the objective identified. The second one is regulatory arrangement must be cost effective. Of course, a judgment has to be made on how far the objectives are pursued and what cost is reasonable to bear. Cost of regulation must be distributed equitably. Then the next one is regulatory arrangements must be flexible. Regulatory arrangements should be practitioner based. For example, the regulatory and the regulator must have a good relationship, and the regulated must be involved in the process of regulations. That's all. Thank you.